Chapter 3, Part 2, Applying Overhead to Jobs, and now we're going to look at the journal entries. Now, this is something you have in your homework, plus you have on your SLO, so you should pay attention to this. Now, cost flow. We add direct materials, direct labor, and overhead to work in process, and when we complete them, we transfer them to finished goods, and when we sell them, they go to cost of goods sold. Effects of allocating overhead based on cost drivers. So let's look at an example. Your company has decided to bid on a job that takes 1,975 in machine hours and 1,600 direct labor hours to produce. The direct labor cost will be $12 per hour and direct materials will be $25,600. Your markup on similar jobs is 29% above total manufacturing costs. The estimated total overhead cost is $369,260, and estimated annual labor hours 9,980, and estimated annual machine hours is 18,463. A competitor has bid $125,500 to do the same job. What effect does the cost driver have on determining the bid? So the first thing we want to do is let's determine the manufacturing overhead rate the applied rate based on estimated machine hours versus direct labor hours. So machine hours would be $20 and direct labor would be $37. So now let's take a look at what that means. So our direct labor would be the same. The direct materials would be the same, but the overhead would be different based on which cost driver we use. And so in this case, if we were to use machine hours, we would be able to, at least on the books, show a profit, and we'd be able to match or maybe do 120,000 for our bid. So this is just something to think about, but you want to make sure you really have a handle on your costs when you do this. Now let's do our journal entries. So here are a bunch of transactions, and we'll walk through each one of them. And I'm also doing T accounts so you can see what that looks like. I always do T accounts. It helps me visually see what's going on. So the first thing we did is purchase 470,000 in materials. We're using perpetual, and we're a manufacturing company, so that's going to go to raw materials inventory, and we assume we didn't pay for it because usually you don't have a bag of cash around, so it would be accounts payable unless they tell you they paid cash. Then we had total manufacturing wages of 115,000. 36,000 was for camper 1, 28 for camper 2, and 19,300 for camper 3, and the balance went to overhead. So we would do work in process 83,300, overhead 31,700, and wages payable or cash for the difference. Now, what would that look in our T accounts? This is a good way for you to keep track. So here's the T accounts we need. So we would show the purchase of our materials. Then we would show our direct labor and indirect labor being charged. And if you notice, I show it by camper because I want to keep track of each project separately, which you would do. The next thing we did is we issued direct materials, and we show the amounts for each one of the campers, but the journal would just be work in process, and we would take it out of our raw materials. Now again, here what we would do is take it out here, but we would show it individually because we do want to keep track of the cost for each one of the campers. Now the next thing we did was we had manufacturing overhead costs, and then we allocated based on 60% of direct labor. Now here's what it would look like. Applied, and then I would take the direct labor times 60% for each one of them, and I would get this. Now the next thing that happened was camper 1 and 3 were completed, so they've got to come out of work in process and go to finished goods. So luckily I've kept track of the costs, and what I would do is add that up and then The two campers, camper 1 and 3, I would transfer to finished goods. Again, I would keep them separate. Now we sold camper 1 for $200,000. So accounts receivable and sales revenue and cost of goods sold, and we take it out of finished goods. So it comes out of finished goods and it goes to cost of goods sold. Now with the arrows, you can see how the costs flow. So they go from raw materials to overhead and work in process, from work in process to finished goods, from finished goods to cost of goods sold. Now, ending balances and closing overhead. So we would come up with our ending balances for raw materials, work in process, finished goods, and overhead. But overhead, what we have to do is determine whether it's under or over applied. In this case, it is under applied because our costs exceed the amount that we applied. So what we need to do is take that to cost of goods sold. So it's going to increase our cost of goods sold. So we zero out overhead because it doesn't appear on the financial statements, and we add it to cost of goods sold. And then our ending inventory would be 438,280. And that concludes this presentation.